Okay, in today's video, I want to talk about diversification. And oh, you thought I was going to put tax, right? Tim's, well, now you were right. It's Tim's tax diversification discussion. Now, the term diversification, maybe you're familiar with. It's historically used when we're talking about an investment portfolio, right? Do we have all our money in stocks? Do we have some money in bonds? Do we have some money in cash? Or maybe some other assets like gold or real estate. That's diversification. To simplify, it's, we want to make sure we don't have all our eggs in one basket. Because if something goes wrong, then, well, we know that it will affect a bigger piece of your net worth than if we split it apart. All right. Now, I want to talk about a different kind of diversification today, and it's, well, Tim's tax diversification. So let me just kind of show you 3 different buckets, okay? Now, the first bucket that we have is the taxable bucket, all right? Now, in the taxable bucket, this is things like your checking accounts, savings accounts, brokerage, investment account, okay? When you have dividends, interest, or gains in those, you pay one of 2 things. Well, you pay tax on it, but it's either ordinary income or it's capital gains, okay? Let me just briefly pause and explain that. Ordinary income is, it's like you're getting a paycheck. That gain that you have just goes on to your income, and it's as if you made that much more on top of your salary I'm referring to, right? Capital gains, so ordinary income could be 22%, all the way up to, 37, 39%, okay? Capital gains rate is 15%, and up to a certain level, it jumps up to 20%, okay? But capital gains is typically if an investment is held for more than 1 year in a taxable account, all right? So you can control the taxes to a certain degree, but it's either basically ordinary income, which is more than capital gains, all right? So the next one is tax deferred. Now, we know this as our 401k, 403b, okay? Maybe you got a 457 from a government plan. And also the ever so popular traditional IRA. This is money that you put in pre-tax. It grows on a tax-deferred basis, so none of this money is the gains, there's no tax on that. The taxes come due, okay, when you take the money out, all right? Now, the interesting thing about this is that when the money comes out, it's ordinary income, all right? So it's not going to be capital gains. Now, we talked about what the brackets are now. You might be in the 20, the 22, or jumps up to the 33 or 39. Now, you can let that money grow and accumulate and compound, which is a good thing. But here's the problem. People, in some cases, there's so much money in these IRAs. I'm just going to draw a little line here. At age 72 now, people have to take something that's called a required minimum distribution. We call it an RMD, but it stands for required minimum distribution, and it's exactly what it sounds like. At age 72, the IRS makes you take money out of this account. They said, okay, you've been growing it long enough. We need to get some taxes on this stuff. And they impose this RMD, and you have to take it out, and you have to pay what the tax rates are at that time. Now, if you're 40, and in 32 years, you're going to have to take an RMD, who knows what the tax rates are going to be? Are they going to be the same? Are they going to be higher? I don't know. But you don't control that, right? So you think about it this way. The final point on this is you have a partner on this account, okay? And that partner is the IRS. And this is really the only scenario where you can have a partnership, and the percentage that partnership, that they get, they can change, okay? And they change it by, changing these ordinary tax rates. All right, let me hold off on that for a second, and we'll come over here to tax-free. This is where you have an account, and this could be the famous Roth IRA. In some cases, people invest in municipal bonds. We call them muni bonds. And they might invest those in this taxable account, but the income that they provide is for the most part tax-free. There's a few that are taxable, but for the most part, muni bonds pay tax-free income. And the last are properly structured life insurance, okay? Where the income that's drawn from that, if it's structured properly, can be tax-free, all right? So, you know, when you think about these different buckets, take a look at your portfolio. Take a look at the things that you have and say, look, is this in a taxable account? Is this in a tax-deferred, tax-free? Now, a lot of times what we see is you know, people might have about 20% in their taxable accounts. A large portion of their assets are in their retirement account, usually between 401ks and IRAs. And a smaller amount is in tax-free accounts, okay? Because there's limitations about how much you can put into a Roth IRA, right? I think it's 6,000 in 2021, 6 or 7,000. Okay, now when you look at this balance, you say to yourself, all right, if I've got this much in a tax-deferred account, I've been growing it and not paying tax along the way, but when I'm forced to take it, our tax is going to be higher or lower. I think having that discussion with about your strategy and figuring out, you know, do I need to move some more money here where I can have some control on the taxes, because at capital gains rates I can control if I hold it for a year or less? Or do I need to be shifting some money, maybe paying a little taxes now on what we call the seed, all right, the smaller amount, versus over here where you're paying it on the harvest? All right, that might be a little low here. So anyways, the key takeaway here is whether you're a seasoned tax professional or you're just getting started out and you're thinking about diversifying a portfolio, also think about the tax diversification of the different types of accounts you have. If you got any questions, or I hope this was helpful, we'll see you on the next video.